So the letter U means the video is fit for any age group. A UA certificate requires parental guidance for children below 12, and A is for persons aged 18 and above, and an SC certificate. Wait a minute, what's SC? SC means senior citizen, and this video is strictly for them as we go through 9 different ways of investing one's retirement money. So many of you might not need this video now, but if you have parents, uncle, aunties who are in their 50s, 60s, or if you help them manage their money, then this video will add a lot of value. Senior citizens, and by extension my parents, have some pretty predictable goals. Firstly, they want to receive some regular income to run the house. Secondly, they should be able to manage big and sudden expenses like a medical emergency. They want to leave their children some money, and they want that financial assurance that that money will not run out. These 4 objectives is what I'll try to address in this video, and let's begin with post-retirement product number 1. The interest received from fixed deposits is a very popular way of generating regular income among senior citizens. Now, when I use the word fixed deposit, I'm referring to 3 different investment sources. The first is a bank fixed deposit, which is extremely safe, and it's safer because of the 5 lakh deposit guarantee insurance that comes along with it. Secondly, bank fixed deposit accounts are very easy to start and operate. They also offer fixed returns, which can be quite comforting. And as a practice, senior citizens receive an additional interest of 0.25 to 0.5% on their deposits. In fact, from time to time, a few banks even come up with some special offers for senior citizens. For example, the State Bank of India has a VCare program that offers an additional 0.5% interest on FDs that's over and above the 0.5% that they anyways give to senior citizens. Similarly, ICICI Bank has a Golden Years program, and from what I've heard and read, these offers have a time limit to it, and the SBI and ICICI promotions are expected to expire in the next 3 to 6 months. Now, a lot like bank FDs, there are company or corporate fixed deposits. These are offered by non-banking financial companies like HDFC Limited, Bajaj Finance, PNB Housing, Mahindra Finance, Shriram Finance, etc. For example, I see a lot of these Shriram Finance ads on the internet these days, and at the time of recording this video, they are offering an interest rate of 9% to senior citizens for a 5-year FD, and if the depositor is a woman, then the interest rate goes up by an additional 10 basis points. Now, while corporate FDs work a lot like bank FDs, there is no deposit insurance in them, which means unlike banks, there is a slightly higher risk of one losing their principal in case the NBFC withdraws. And for this higher risk, companies offer depositors a higher rate of interest, and as one can see in this table here, this differential can be pretty considerable. I should also mention that many NBFCs carry a high credit rating, and as a rule, retirees should only invest in AAA rated papers, which symbolizes the highest level of safety given by credit rating agencies like CRISIL, CARE and ICRA. A third source of FDs is the post office, which is something called the Post Office Time Deposit Account or POTD. These accounts currently offer an interest rate of 7.5%, and to draw a comparison, I would say the post office time deposit is even safer than a bank FD, because while the principal and interest is protected up to 5 lakhs in a bank, in case of a post office, your entire investment is backed by a sovereign guarantee. So here's how our 3 deposit instruments look based on different parameters. And as a practice, do check these for accuracy before taking any investment decision. Also remember, FD returns are generally in line with the country's inflation rate, which means the value of your money is pretty much where it was when you first made that deposit. So as a suggestion, retirees should have a mix of fixed but moderate return instruments like FDs, and their portfolio should also include some volatile but potentially high return investments so that their wealth can continue to grow on a real basis. The Senior Citizen Savings Scheme or SCSS is a government-backed retirement benefits program that anyone above the age of 60 can avail. The maximum investment under this program used to be 15 lakhs, but in a welcome move, the Ministry of Finance recently raised the ceiling to 30 lakhs. One can invest in an SCSS from their nearest post office or bank, and it has a 5-year tenure which can be further extended by 3 years. Now, in addition to this high investment limit, the Senior Citizen Savings Scheme offers one of the highest interest rates amongst all fixed income small saving plans. For instance, the annual interest rate for this April to June quarter is 8.2%, and this interest is payable on a quarterly basis. Now, notice I said interest rate for this quarter, And just to elaborate, the interest rate is actually market linked, and the government announces a new interest rate every quarter, which is 100 basis points or 1% above the yield of a 5-year Government of India bond. For instance, look at this graph here, and as expected, the bond yield goes up and down and within the 5 to 8% range. Now, these green boxes represent the previous SCSS interest rates, and as one can see, there is clearly a 1% markup that the scheme offers over the bond yields. However, when the yields fell dramatically in the year 2020 and in the first half of 2021, per the scheme's mandate, the interest rate should have been slashed down to 6.5%, which didn't happen because then there would have been a massive public outcry. So the government took the hit upon themselves and continued to keep the interest rate at 7.4%. And now that the yields are somewhere around the 7.2% mark, the SCSS interest rates have followed their yield plus 1% mandate, and they are rightfully at 8.2% at least for this quarter. Now, I explained this interest rate construct to give all viewers a background, but to make things clear, although the SCSS interest rate is reviewed quarterly, once an investor subscribes to it, the rate that was prevailing at the time of subscription will now be fixed for the entire tenure of the investment. So you invest now, you receive 8.2% per annum for the entire 5-year period, which makes the Senior Citizen Savings Scheme one of the highest interest rate products amongst debt instruments and a must-have in any retiree's income generation portfolio. The Department of Post has a 5-year maturity scheme called the Post Office Monthly Income Scheme. The product pays interest on a monthly basis and can therefore be a suitable investment option for senior citizens who want regular payouts and are not comfortable investing in equities. Now, per current rules, one can invest up to 9 lakh rupees in this scheme, and the interest rate, which is set every quarter, it's currently at 7.4%. Again, the interest rate at which you make the investment is fixed throughout the entire 5-year tenure, which basically means the POMIS is nothing but a fixed deposit with a monthly payout. The scheme carries some additional terms and conditions around premature closures, early withdrawals, penalties, etc. And you can find a lot more details of this on the India Post website. For your benefit, I have listed down some useful websites and resources in this video's description, so do have a look at that and do your own research before taking any investment decisions. So the story we have heard is retirees and senior citizens should not invest in equities because the markets are unpredictable, which is another way of saying we don't know if it is going to go up or down. Well, come to think of it, the same problem exists with fixed deposits as well. And just a couple of years back, banks were offering just 4.5% on a 3-year FD. Anyways, I'm raising this point because if our portfolio's post-tax return is less than 6.5–7%, then we have a problem because it means our wealth is decaying. Point blank, senior citizens need reinforcements, which has to start by apportioning some portion of the portfolio to equities, and this can be as low as 15, maybe 20% of the portfolio. If this is new to you, then I strongly recommend you work with a fee-only financial advisor. But just to help out, here are some mutual fund categories, some combinations that can be explored keeping in mind your own level of comfort. So this is where to invest the retirement money. But one of the other requirements is accessibility, that is how to withdraw this money on a frequent basis. Now there are two methods that one can consider here. The first is opting for plans which are tagged as IDCW or income distribution cum capital withdrawal. In simple words, these are like dividend plans wherein some money is extracted from the mutual fund NAV and is paid to the investor. Now, in my view, these IDCW plans are a less than ideal approach as it is neither tax friendly nor is the payment of dividend regular and guaranteed. The second option is the use of SWP or a systematic withdrawal plan, which is a much better redemption strategy as it allows investors to withdraw a fixed amount of money at regular intervals from their investment corpus. This generates a predictable cash flow for the retiree, and this approach offers a lot more flexibility in terms of the withdrawal amount and the frequency. So remember, there are two parts to mutual funds. A, how should one go about creating a portfolio that beats inflation and yet is within the senior citizen's comfort zone? And secondly, some thought has to go into the redemption strategy, which can pay for regular expenses and also support any ad hoc expenditure like a vacation, medical expenses, home improvement, etc. One of the safest instruments out there are government bonds, and these come in the form of treasury bills, dated securities, state development loans, etc. From what I've seen, it's a less explored option because investors don't know where to start. But to list down the benefits first, these government issued securities are super safe with no credit risk to your principal or to the interest. These are available for long tenures like 10, 20, even 30 years. So if you're saving money for inheritance, then this becomes a natural choice. The bonds offer semi-annual interest payments. They are liquid in the sense that they can be sold in the secondary market. And although bond prices go up and down depending on the interest rate, when you hold a bond until maturity, the investor has a clear idea of the returns that he or she will make. And historically, this is in the 6 to 8% range. In fact, at the time of recording this video, a 10-year GOI bond was yielding around 7.3%, while a 5-year paper was at 7.1%. Now, buying a government security is a lot easier than it looks, and there are many ways to go about it. A GSEC can be purchased from a bank or a post office. It's available with stockbrokers, including the online ones. A mutual fund or ETF is an excellent way of buying government securities, and in particular, look out for target maturity funds. Then there are many online aggregation platforms where bonds can be bought and sold. And finally, there's the RBI Retail Direct Scheme through which individual investors can directly purchase all kinds of government securities. My point is, senior citizens should definitely consider investing some portion of the corpus in GSEC on account of the benefits it offers, and especially if the yields are somewhere close to what is being offered by other fixed deposit instruments. And while we are on this subject, I'll request everyone to read up on the Government of India Floating Rate Bond 2033, which has been recently launched by the RBI at a prevailing interest rate of 8.51%. So that's a little homework for you. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. An annuity is an insurance contract that's designed to generate a steady retirement income for the annuity buyer. To put it simply, you can approach a life insurance company like LIC, HDFC Life, ICICI Prudential, etc. You then invest a lump sum amount, and the insurance company gives you a regular payout as per agreed terms for the next many years into the future. For example, LIC of India has just introduced a new Jeevan Shanti plan, which is a non-linked, non-participating individual single premium deferred annuity plan.
Say that again.
Sure, it's a non-linked, non-participating individual single premium deferred annuity plan. And the way this works is, let's say someone purchases an annuity of 10 lakhs at the age of 45. Now, because this is deferred annuity, this person sits tight for the next 12 years, allowing the corpus to grow. Which means from the age of 57, the annuity buyer will receive a pension of 11,192 rupees for the rest of his or her life. Of course, this number will vary depending on the age, the amount, the deferment period, but this is pretty much how an annuity plan works. Also, there are many variants of annuity plans that are offered by different life insurance companies. But what might be an ideal one for senior citizens is what is called an immediate annuity plan, where the annuity buyer puts in the lump sum money and immediately, that is as early as from the next month onwards, the person starts receiving a regular pension every month. So check with a few life insurance companies, and if you're an NPS subscriber who's about to reach the age of 60, then the knowledge of annuities is all the more important, as a decent 40% of the NPS corpus has to be used to purchase an annuity. So do read up more about this. Real estate or property is a tried, tested and generally successful way of investing, and I know of many senior citizens who have bought 2, even 3 houses in their lifetime. Of course, they stay in one of those houses and the rest have been put on rent, which gives them income on a monthly basis. In fact, many of us would have noticed that while the price of property, like an apartment or a shop, while the price of this property goes up and down by plus minus 20%, the rent that we pay or receive is a lot less volatile. It's this stability that attracts senior citizens towards rental income in spite of that added work around maintenance, property tax, bills, dealing with brokers, etc. So the big question is, assuming one has the capital, a crore, maybe 2 crores, should he or she buy a property and put it on rent in their post-retirement years? Well, there is no off-the-cuff answer to this because A, it clearly depends on the rental yields one can expect, And secondly, and especially for us Indians, our goals of owning a property go beyond money, and we generally want to leave a house to our children as a part of their inheritance. But sticking to rental yields in India, and especially for residential properties, the yields are generally in the 2 to 3% range, maximum 4% depending on the city you live in. For commercial properties, the yields are a bit higher, but once we shave off a percentage for maintenance, security, taxes, etc., the returns are pretty much around the inflation rate, which is definitely not a situation we want to be in. Of course, there will be some exclusions, but in my view, there has to be a strong mathematical basis when investing in property. However, if you want to have some exposure in real estate and you don't want to commit a huge sum of capital, then do explore investing via other alternatives like REITs, crowdfunding, timeshare, and fractional real estate. A reverse mortgage is a post-retirement financial product that gives senior citizens a regular source of income. The process starts with the senior citizen pledging his or her house with a bank, and the bank pays a regular amount to this individual over a period of time. So what has happened here is that the house becomes the collateral, and while technically the bank is giving a loan, it doesn't pay the entire amount upfront, but it is giving it in monthly installments. Now this might be a little confusing, so let me explain this with an example. So sometime back, the Punjab National Bank's reverse mortgage scheme was paying 435 rupees per month per lakh for a tenure of 10 years. Which means for an appraised home value, a loan of say 1 crore, this comes to a monthly payout of 43,500 rupees, which is a decent sum of money. But what makes this monthly payout of 43,000 even sweeter is that the borrower doesn't have to pay back this amount. What I mean is, if the borrower outlives the tenure of the loan, which in our case is 10 years, then as next steps, the bank will simply stop making any more payments. But this does not mean that the borrower, the senior citizen, has to vacate the property. In fact, they can continue to stay on the property until their death. Now, when the senior citizen does expire, there are two available options. Option 1 is where the legal heirs can keep the house by repaying the loan of 1 crore with interest. And option 2 is where the bank can sell the house to recover their dues, and whatever remains post the sale is paid to the legal heirs. So as a borrower, as a senior citizen, you get to stay in your house until you die. You receive monthly income at least for a few years. Your legal heir will not be sandbagged by the bank. And if that's not enough, per a recent court ruling, the monthly installments that the bank pays, well, that money need not be treated as income and therefore is exempt from taxes. In my view, a reverse mortgage is a very handy instrument to boost up a senior citizen's monthly income, and it's something one should definitely give a thought to when planning your post-retirement financials. Okay, retirement doesn't mean one should stop working. It's a choice, and I know many people who continue to work either full-time or part-time on consulting projects, remote assignments, taking classes at a nearby college, becoming an insurance agent, etc. From a financial standpoint, this can be an excellent strategy that ensures one doesn't run out of money and your expenses can be taken care of from what you earn. In my opinion, the seeds of what you want to do professionally in your 60s and 70s should be sown a lot earlier by developing one skill, your network, and a touch of personal branding to go with it. And this concludes our 9 retirement strategies that I wanted to put forth in this video. Every product we have discussed has its own peculiarities in terms of expected returns, tenure, liquidity, taxation, and related parameters. And my sincere suggestion, if you are a senior citizen or if you know someone who would find this video helpful, is to encourage them to understand these products and start looking at multiple streams of retirement income rather than relying on just 1 or 2 areas. For instance, if you were to rely only on fixed deposits, then a sharp turn in the interest rate cycle, something we saw in the year 2020, can really mess up your monthly income calculations. The same thing goes if you're totally dependent on rental income, because a tenant moving out means you won't have any money coming in as the house is still unoccupied. So have a portfolio view on your post-retirement income pie, and if you are in your 40s or 50s, then now is the best time to build it. I sincerely hope you learned something new today, and if you know any senior citizens, then do forward this video to them. Thank you once again for your time. Do like this video, share it with your friends, and I'll see you next week. Until then.